So recently, we had to file our income taxes. And I don't know about you, but as a first timer, I had zero clue about what to do. It felt like a blur, you know. I remember a lot of panicking, trying to call up my mother, remembering if my school friends became CAs or not. Basically, it was too much. And that's fair too, right? It can be quite a stressful ordeal for anybody filing their taxes for the first time, or the second, or the 10th. And that's probably because nobody broke it down and made it easier for us. But what better time to do that than now? So we can go ahead more informed and less terrified of filing our taxes. Before we deep dive into this with our expert, let's start off with the absolute basics. क्या है ये ITR? ITR stands for Income Tax Return. It is a form that individuals or businesses have to submit to the Income Tax Department to prove their income and expenditure for a financial year. The tax liability of a taxpayer is calculated based on his or her income. In case the return shows as excess tax has been paid during a year, then the individual will be eligible to receive an income tax refund from the Income Tax Department. How much tax you have to pay is based on the slab of income you fall under. You can refer to this table right here and check that out. There are also several ways, legal ways, in which you can save on your taxes, optimize your salary, and get a better handle of your finances. Now, I did a lot of research, but ye short mein nahi bata sakti. And that is why I have got just the right person with me. Someone who knows both finance and YouTube like the back of his hand. Founder of Avalon Scenes, an ex-investment banker, entrepreneur and finance content creator, Shashank Udupa.
Hey, Tanishka, how are you?
I am good. How are you? I hope you're having a good day.
Yeah, it's just started, so it's going on well.
So, have you filed your taxes?
Yeah, because they all scared me saying that if you don't file it by the due date, which is July 31st, then you have to pay a lot of penalty charges. So I think I filed it 4 days ago. It was quite a hectic process.
So, you know what? Let's just get into the basics to start off. Can you give us maybe your own macro view of what ITR is and how it functions in our country? Just briefly, perhaps.
Got it. So I think India is one of the only countries where the number of people filing their income tax returns is very low. And the main reason I feel for this is because lack of education as well, right? A lot of people don't know, even if they're making more than 2.5 lakhs or 3 lakhs a year, they don't file ITR because they don't know how to do it. And there's always this notion that, okay, you know what, I need a CA to file my taxes. That's been the common notion. But that's not true because you can do it by yourself as well. And if you look at our entire country structure with respect to ITR, right? So ITR is nothing but income tax return. Now, ITR is basically us telling the government that, okay, boss, this is me, Shashank, who has earned so much last year, right? And I'm telling you and declaring this to you, right? And then I'm paying this certain amount of taxes as well to the government. And this is from my contribution, from my behalf, after all the deductions that are there. Now, why do people do this? There are two reasons, right? One, if I don't do this and then I get caught, then if I get caught 3 years later or 4 years later, I have to pay the interest for all these 4 years. So ideally, you don't want to get caught, right? Might as well just declare it and pay off your taxes. The other benefit here, you can say like, you know what, I never get caught. That's fine. The other benefit here is a lot of financial institutions in India make decisions on your credit worthiness depending on your ITR. So if you're filing your ITR, whether it's big, small, doesn't matter. If you're just filing your ITR, even if you have a salary of less than 2.5 lakhs, it still helps you a lot when you want to go tomorrow, get a loan or personal loan or a housing loan or something like that. It helps you a lot. So this is a good thing to do, to just keep filing ITR, even if you're not in the tax bracket. But if you're more than 2.5 lakhs and if you do not file it, then if the income tax government tomorrow comes and finds out that, okay, you know what, Shashank, you've not filed your ITR, but I just saw that your recent Aadhaar card or PAN card has been linked to a new car that you've bought. How did you do that without filing an ITR? Or if your ITR is only 3 lakhs, how do you buy a car worth 20 lakhs? So these guys have algorithms that actually flag and figure out stuff. So if you do not file your ITR and you do get caught later on, as I said, if I get caught in year 4 or year 5, the penalty will be huge. There's a one-time penalty and I have to pay whatever interest that I have not paid the tax. I have to pay interest for the last 4 years compounded. So ideally, it's safer to just abide by the laws and just pay off your ITR.
Right. If our audience is looking for anything in particular, we have very conveniently listed down all the chapters below. You can just skip right ahead to whichever topic you'd like to see. But for now, in this section, we just cover some of the basics.
Yeah.
So first question, and this is something that even I was very curious about. Our normal year ends on December.
Correct.
Our financial year ends in March, I think.
Yeah.
But if we file taxes in like July, August, how do you keep track of all this? What is the financial year? What's our assessment year?
So look, forget about the December, January to December, right? That's just when you celebrate New Year's and have fun with your friends. Forget about that. Our financial calendars, March 31st ending, starts on April 1st. So April 1st determines the next financial year and it ends on March 31st. Okay. Now, when you see the income tax returns, there's two questions they ask you. What is the financial year and what is the assessment year? Okay, so as the name suggests, let's understand simple logic. Financial year is that year where you're earning the money in that period, the income of that period, right? So for example, if you say that April 1st, 2022 to March 2023, March 31st, 2023 is your financial year. Okay, so I'm like, okay, cool. So whatever I'm earning right now comes in 22-23 financial year because I'm earning right now. But when I file my taxes or when I tell the government, you know what, hey, I made so much money, that is going to happen after March 2023. Now, when you say that it's after March 2003, say for example, now July 31st, right? This comes as assessment year of the next year. So 2023 to 22-23, right? So assessment year is the year that the financial year that you're getting assessed, and financial year is the year you're making the money, right? So you'll know it. And also, I think you should just make 1 or 2 friends who are CAs who can also inform you about this, right? But the country, the government lets you know that this is the filing date.
So how does one decide which regime would they benefit from the most? What is the difference between the old regime versus the new regime?
Now, there's 2 options here, right? Now, one, for a person who's paying income tax in the topmost bracket, say 33% and above, 30 plus, cess, vest and all that, 33% above, they have 2 options. Everyone has 2 options, but this benefits those guys. So the first regiment, which is the old regiment, takes care of all these deductions. So in that, you can say that, I have this ELSS that I have few other options. So I'm going to get up to 1.5 lakhs or up to 2.5 lakhs you can save under deductions. And the tax rate is slightly higher than the old regiment. But if you are in the new regiment, right, there is no deductions, but the tax rate is slightly lower. Right, that is the main difference over here. So now it depends on which class of income bracket you are in. If you're in the 2 to 3 lakh bracket, right, then doing a 1.5 lakh ELSS or the 1.5 lakh ATC will not make so much sense. Then you can actually go in the new regiment where the tax is, I think, half of what it is in the old regiment, right? But if you're in the highest bracket, and then you're like, okay, you know what, anyway, I'm going to pay so much tax, might as well do some savings for myself and get as much benefit as possible that I can. So that is where the old regiment comes in. So the old regiment is great for people who want to save and get deductions and in the higher income group, whereas the new regiment is great for people who are in the lower to middle income group, which is 2.5 lakhs to maybe 5 to 7 lakhs at that point. So it's beneficial for them. So basically for salary, right, you guys are very lucky. I'll tell you why. Because for you, there is a rule that where the upgrad, say for example, your company has to deduct the tax on behalf of you. So that is where TDS comes in, which is tax deducted at source. So if you are working in a company and that's your only income at the end of the year, right, you do not have to pay anything to the government at the end of the year. Why? Because through your salary, the government has constantly been taking it from your employer itself. So if you go to the income tax portal to file your thing and you put your PAN card number, it'll automatically show that, hey, you know what, Tanishka, upGrad has already paid so much amount of tax on your behalf. Okay, that's great. If there is any difference that needs to be taken from that, then only you have to pay that difference. But usually what happens, HRs itself will talk to you. Now, if you ask me what is the best way to maximize tax savings for an individual, right, a salaried individual. Now, let's go one by one. The first thing is called standard deduction. So whether you're an individual freelancer, whatever it is, the government itself says, you know what, 50,000 rupees from my side, maaf, right? It's an exemption. So if your taxable income at the end of the year or total income is 10 lakhs, it'll be like 50,000 you remove, 9.5 lakhs you will pay tax on. Okay, so we'll be like, okay, Tanishka is like, awesome, 9.5 lakhs I have to pay tax on. Then there is something called ATC that comes in. Now, ATC has a lot, ATC is a section, but it has a lot of ways where you can save. So ATC is only saving. Right? You have PPF, you have Sukanya Samriddhi scheme, you have ULIPs, you have ELSS, you have like 15 different things that you can actually save it. But whatever you do, however you do it, the maximum you can get is 1.5 lakhs. If you put more than 1.5 lakhs, it's up to you, right? But you will only get 1.5 lakhs exemption. So now you said, okay, cool, let me do this 1.5 lakhs on ATC. Your 9.5 goes down from 1.5 lakhs to 8 lakhs now. So your taxable income from 10 has automatically come down to 8. Next, the government says, hey, Tanishka, do you have a medical insurance? We're like, no, not yet. Please take it. We will take off that cost as well. So the medical insurance, you can take up to 25,000 for you. And if you have parents at a particular amount of age, which are, senior citizens, and you want to take some insurance for them, you can do that. And the government will give you up to 50,000. Now, 50,000 cover a premium is very high, right? You'll get more than 1 crore, 2 crore cover, right? But you can get the maximum benefit up to that point. So let's assume you take 25,000 benefits. So automatically from 8 lakhs, you're now down to 7.75. So now you're at 7.75 and most of it has come here. Now, in the course of the year, right, if you have done some donations, right, you have given it to some charitable institution, you have given it to say the COVID relief fund. So whatever that amount is, depending on how that entire unit is structured, you'll get either 50% or 100% of that amount as tax exemption as well. So let's assume I did 1 lakh rupees into the COVID relief fund, which had 100% tax exemption. Now, automatically from 7.75, you come down to 6.75. Now, that is the tax you pay at the end of the year. Now, in this, there are another few things that your HR will help you with. For example, you have HRA. Okay, so that's the difference now. Freelancers don't have HRA. Okay, because problem, but whatever. Salary guys have HRA, but again, it's up to a limit, which is from your base salary. You have also something known as LTA, which is leave and travel allowance, right? So that is also there. Apart from that, you can get a few other things reimbursed, like your mobile bills can be reimbursed. Sometimes they give you Sodexo meal coupons that also acts as a benefit, right? But all of this goes from your main salary. Please understand that. So you can sit with the HR on day one and decide, you know what, HR, I want a lot of cash in hand. Don't give me all these coupons because I feel I can grow this money much faster and much better. Then what will happen? They'll be like, okay, you will manage the taxes for all of that. Or you can be like, no, you give me the most tax efficient scheme where my cash in hand is low, but also my tax payout is slightly lower. So that is the benefit that salaried employees have.
Do you have any personal advice for anybody who wants to optimize their salary and who wants to optimize their savings to get the most out of their APR?
I think two things, right? Number one, if you're a salaried employee, I think usually what happens is most individuals do their tax planning towards the end of the year around Feb. Right? This is where most of us are like, oh my God, we have to save, March 31st is coming. And then when you look at all the benefits that you need to do, you need to have liquid cash of 1.5 lakhs to get the maximum benefit for ETC. Another 20-25K for, say, for example, your medical insurance. So ideally, it is better for you to start your tax saving immediately after March 31st. From April 1st, to start your tax saving. Now, a simpler way to do this is just to create a 12,000 rupee or a 13,000 rupee SIP every month, right? If you do this SIP, because 10,000, 12,000 rupees from a monthly basis will not affect you too much. But in the end, right, towards the end, it will save you a lot of money, right? And you don't need that extra 1.5 lakhs directly to start doing your tax saving. So ideally, take some ATC instrument, whatever you like, that's up to you, and start investing 10 to 12,000 in that every month. So towards the end of the year, you're already at 1.5 lakhs and you're sorted and you're done. So I think that is something that a lot of people don't do, a lot of individuals don't do. I definitely feel you should do that in the beginning of the year itself. So I would say your HR is your friend. A lot of people don't like HRs because they feel like just cutting money from you. But that's not the case. It's not in their hand. It has to go to the government. But if you talk to the HR and become their friend, get them a cup of coffee and sit down and say, boss, save my taxes for me, they will openly help you out a lot. Just try this out once.
What about people who are their own business, freelancers?
But there's a beautiful scheme which very few people know. Again, it's called the presumptive tax scheme, right? Now under this, which is section 44 ADA, what I can tell the government is, you know what, I'm a professional, okay, so I have expenses as well, right? Obviously I have some expenses because I have a team. I have a guy who's editing my YouTube videos, who's doing the script writing, etc., etc. So what I can tell the government that 50 lakhs is what I earned. The government will be like, okay, you're a professional. I will automatically assume 50% is expenses. So now my 50 lakh income, government says your expenses is 25 lakhs. Now my taxable income comes down to 25 lakhs, directly 50% off. Now my expenses might not be 25 lakhs, right? But the government's like, I don't care, right? You're an individual who's a professional who's helping the economy. So we're going to give you 50% off assumption. Now, if I'm spending more than 50%, right, then I can tell the government, you know what, I don't need your 50% because I'm spending 70%. I will show this to you as well, right? And if you can show your books of accounts, and if I'm an individual, I have to maintain individual books of account, pay my CS some money to do this, then I can get more benefits, right? But ideally, if your freelancer is not making more than 50%, then there's something wrong with the freelancer as well. So ideally, keep as much as possible over there. Now, 50 lakhs has come down to 25 lakhs. I'm still in the highest bracket, right? Now, on this 25 lakhs, I can again take exemptions. 50,000 goes into standard deduction, 1.5 lakhs goes into ATC, 25,000 goes into your medical expenses. So all of this gone as well, right? Now, another benefit here is if I have a home loan, right? If I have a home loan for myself, then I get the interest component that I pay is also considered tax exemption, right? Now, there's another beautiful thing that can work. I think I missed this out, which can work for both individuals, salaried and self-employed, is education. So if you're trying to do any kind of education, I'm not talking about international education, right? Even if it's local education, you got into IIT, IIM, you want to do some kind of education, which is a executive course, right? And you take a loan on it. So even the interest that you pay for an education loan is considered tax exemptions, right? Because the government wants you to get educated, wants you to learn, wants you to save. So you get benefits there as well. So if you have taken an education loan, don't forget to tell the government, boss, I have paid 1-2 lakhs in education loan. Please give me some money back. So all of these benefits come there. Whereas for salaried employers or self-employed under the 44 ADA, you get the maximum benefit. For all the people who didn't know this are paying tax on 50 lakhs. But this is only up to a limit of 50 lakhs. Above 50 lakhs, you don't get this benefit, right? Because then the government's like, boss, you're making enough. Aajao, de do pura. Right? So that is what the logic is.
So what about a person who's salaried as well as, they have their own ventures going? They have their own streams of passive income.
So I used to do that, right? So for example, last year I had an income from my company, which was Avalon, which was a salaried income. And I was also making, other income or freelancer income from YouTube revenue, from brand deals and etc. Right? So if you look at my ITR, I have that, which is the main income that comes from my salary. And whatever I've got from these other income sources are under section 4480. I've availed both, right? You can do that. So now automatically salaried income to the TDS has cut. So the company only has taken all my tax. So I have to pay zero tax on it. But the other income is something that I'm liable to pay that extra cash. Now, even when brands pay me, right, they cut 10% TDS. Right? But the 10% TDS, they can't cut more than that. It's always 10%. The remaining you have to file with the government and pay the remaining 10, 15, 20% depending on your income bracket. Then they take something known as joint borrowing, right? You've seen this co-borrowing that happens. Husband and wife take the home loan. Now, what happens is both of them get the benefit of that interest component that is there. So that's for working individuals, buying a home loan together is amazing. It's the biggest tax saving and you get an asset that is made as well.
So what about crypto? As in, what if I've invested in crypto and now I don't want to have to do anything with it anymore? Does that have any implications on my taxes?
Yes. So if you have exited the crypto, so first of all, if you have invested in the last 2 years, currently your portfolio is in red. So there is no point removing it as well. So if you remove it right now and you're in loss, then you don't have to pay the government anything, right? It's okay, it's maaf, because you didn't make money out of it. But if you are this amazing investor who's done it and got money as well, then you have to pay tax. It comes in as a part of your taxable income. So it goes under your main income. And whatever your tax slab is, you pay money on that. Now, recently we've seen that if you buy right now, today you start investing, whenever you buy, you need to pay something like a TDS. You need to buy with GST. You have to pay 18% GST. I think 28% is coming out as well. Not sure on that. But you need to pay GST. You need to pay TDS. And every time you get a gain, you need to pay in the maximum slab as well. Right? So that is only on a gain. And that is only when you remove the income. So if you've currently already invested in the last 2 years and you don't have any profits, either you can remove it and you don't even have to tell the government because it's a loss. Or ideally, it is good to just tell them that, you know what, I had crypto and it's a loss. Or just don't remove it and keep it there because it's like booking your loss, right? So it doesn't make any sense at that point. So if you're planning to invest in crypto now, yes, then you need to be clear because this has also happened in US where now they have a separate section for cryptocurrency income filing and India is slowly coming into that front as well. So they're catching everything where you can, have a slippage over there. So apart from that, they also have things like if you are a director in more than 2 companies, you have to tell what it is. If I have a directorship somewhere abroad, I have to tell what that company is as well and how much shares I have in that company. So now they've become very strict with all of these things.
So crypto, I kind of can wrap my head around. But what about stocks? Is it the same? Is it different?
Oh, no. Stocks are completely different. So I'll tell you how the logic of stocks work. And a lot of people are also angry with it. A lot of people are okay with it. So I'll tell you the logic, right? So if I invest some amount of money into stocks, let's assume that I invest 1 lakh rupees today. Okay. Now, after 1 year, okay, imagine just before 1 year, 364 days, I remove the money and I made a profit of 50,000. Now, what happens is, because I didn't hold it for 1 year, I hold it less than 365 days, it comes under something called as short-term capital gains, STCG. Why is it called capital gains? It's because it's my money, which is my capital, which is my post-tax income, right? I've made some money from my salaried income, and that money I'm taking and putting it here. Now, if that happens, on that gain, which is 50,000 rupees, I have to pay 15% of it, right? Obviously, it's not that much. 15% is like still okay, because if you look at your other income group, you might be a 30-35% bracket, right? But if I hold it little longer, right? The government wants you to hold for more than 1 year and become a long-term investor. So if I hold it for 366 days, and by now that 1 lakh has become, say, 2 lakhs, right? And then I sell it. Now what happens? My gain is 1 lakh. Now you might be like, okay, Shashank, now you have to pay tax on that 1 lakh. So now the government says, if you hold for more than 1 year and you have to pay tax on this, and you made a gain, then you pay tax only on the amount above 1 lakh rupees. Okay. So if I have made 3 lakhs in profit over 4 or over 5 years, then I have to pay tax on only the 2 lakhs, because 1 lakh they're removing. On the remaining 2 lakhs, I have to pay 10%, which is 20,000. So now actually, if you think about it, I have made 3 lakhs in profit and I've only paid 20% tax, which is very low, less than 10%. Right? So that is how it basically works. So the government wants you to save and wants you to stay invested for a long period of time. So if you do intraday trading, or if you do day trading, or if you do all of those things, you're under 15% tax liability. But if you are a long-term investor and you hold for a very long period of time, only when you exit the money is when you are liable to do this. Now, there's another beautiful game here as well, right? What the government says is, what if I make a loss? This was on profit. What if I make a loss? So if I make a loss, right, I can carry forward this loss for the next 3 years from that financial year, right? So if I make 1 lakh loss today and next year I made 1 lakh profit, I don't pay any tax, because according to the government size, oh yeah, he lost 1 lakh last year, he made 1 lakh this year, he's net to net still zero. So they're only going to catch you when you make real income and real money. And if you get dividends, they'll catch you on the dividends as well, right? So this is where you actually have to pay tax. So if you make a loss, declare it. I have declared my loss to the government and said, see, next year if I make profit, don't take it from me. If you don't declare the loss and you're like, hey, why should I file the income tax and leave it? Then next time you file your income taxes, you made a profit, the government is going to catch you, because you'll be like, no, I made loss last year, but you didn't file it. So I don't know, as a government, I don't know if you made loss. So then they'll catch you. So that is how it is, right?
So what if this is another hypothetical? I've been working at a company, but then I decide I want to stop working there and I want to switch over to a new job.
Yeah.
So how would this work then? You know, when I'm in between jobs, or if I've left and I'm moving on to something else.
Yeah. The important thing here to understand for a salaried person is the switching of PPF. Okay, your public provident fund. Now that is the most important thing, and that takes time. Why do I say that? Is because if I leave a particular company and they were putting some money into my PPF account, then you're shifting to a new company. You have to shift that account number and give that account number to this new company and say, now you please start putting it here. So there is a very specific number called a UAN number. So you take that, okay, and give it to the new company, and then they start putting that into your PPF. If you don't do this, then you cannot go and claim deductions under ATC, which is PPF is also there. So there's two things you need to do, right? So when it comes to income tax filing, don't worry, your PAN card solves that. But PPF is something your PAN card will not solve, right? It is still recognized, but you have to take it from one employer and say, please shift it to the other employer. Usually what happens at this point, the HRs of two companies, right, either email each other or talk to each other and just migrate it to your system. Right? Sometimes they would have created it for you if you don't have a PPF account. So they have to migrate all the details for you. So these small things happen as well.
See.
Yeah.
Wow, this was exhaustive but very essential information for all of us. I feel a little more confident in understanding ITR, maybe just a little more. Yeah. And I hope that our viewers also find this video very interesting and helpful more than anything else. So just as a parting note, some things to keep in mind: be friendly with your HR, find CA friends, understand your salary slip well, and don't wait last minute.
And also understand the sections. There's only a few sections. People often get confused because there are so many things in tax law. You just need to look at 3 or 4 sections, which is 80C, go through it, 80D, 80E, and 80G. These 4 things, if you go through, it's more than enough. You don't need, all the others are extras, I would say, right? These 4 things are basic. If you go through this C, D, E, G, I think you should be okay. Take some time. It's a once in a lifetime read, right? You just read it once and then you have to just stay updated with the new laws that come every year. But if you do that, you exactly know how to save money, because these are legal ways you can save money by the government. And if you don't, you pay the government some extra fees as well. So even they're happy, right? So please go through it once. It's a small effort from your side.
Thank you so much for all of this information. And thank you so much for spending time with me and all of our viewers. This has been helpful. Thank you so much.
Awesome.
I think this sit down with Shashank is exactly what we needed after the chaotic ITR season this year. Now we know how we can be better prepared, manage our finances, and also get the best benefits. I hope this video is as helpful for you as it has been for me. Let us know in the comments what you think. And don't forget to share this video with your friends who need that extra push to conquer adulting, like me. And definitely subscribe to upGrad's channel because we have so much content coming your way.